So, good evening. So, what did you do? Question what you do? I will start on the second performance measure. Yeah, so we proceed with the portfolio performance measures. We proceed with the portfolio performance measures. We had already listed them, so we cleared the first one. Let us now go to the second performance measure. The second one was meant to be the Trinia's performance measure. So we had already listed them. So go to your notes. We go to the second performance measure. We got the second performance measure, which was meant to be the Trinia's. So when you are discussing the sharps, we discovered that you are using the standard deviation to measure the performance. But now this time around, we shall be using the beta factor, or simply the beta coefficient. The beta factor or the beta coefficient to measure the performance. So let us note something about the Trinia's performance measure. So we can summarize that it indicates the excess returns. It indicates the excess returns. It indicates the excess returns generated by the portfolio. It indicates the excess returns generated by the portfolio, above the risk-free rate, above the risk-free rate per unit of risk, above the risk-free rate per unit of risk of the portfolio, per unit of the risk of the portfolio. So you are saying that it indicates the excess returns generated by the portfolio above the risk-free rate per unit of the risk of the portfolio, as measured by the beta factor, as measured by the beta factor, as measured by the beta factor. It is expressed as follows. 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 So the Trinia of the portfolio will be equal to expected return of the portfolio minus the risk-free rate. We divide by the beta factor of the portfolio. So Trinia of the portfolio will be equal to expected return of the portfolio minus the risk-free rate. We divide by the beta factor of the portfolio. So when you want to get the Trinia of the portfolio, we simply take expected return of the portfolio minus the risk-free rate. We divide by the beta factor of the portfolio. We divide by the beta factor of the portfolio. Then we continue by noting that this index is compared with the Trinia of the market. This index is compared with the Trinia of the market. This index is compared with the Trinia of the market, which is expressed as follows. The Trinia of the market, which is expressed as follows. The Trinia of the market, which is expressed as follows. So, Trinia of the market will be given by expected return of the market minus the risk-free rate divided by the beta factor of the market. So to get the Trinia of the market, you simply take expected return of the market minus the risk-free rate. We divide by the beta factor of the market. But if you recall, we said that the beta factor of the market is always equal to 1. So which means that we can do away with it so that it will be the same as expected return of the market minus the risk free. Because the beta factor of the market is 1, we just remove that part. Because a figure divided by 1 just remains the same. So then we had also stressed that this part is the same as the risk premium. That part is the same as the risk premium, like that. So that region was the same as the risk premium. It was meant to be the same as the risk premium. So that is now how you should be able to compute the Trinia of the market. Then we add there a paragraph by noting that the final decision will be made as follows. The final decision will be made as follows. The final decision will be made as follows. So the first dash is that if the Trinia of the portfolio is greater than the Trinia of the market. So if the Trinia of the portfolio is greater than the Trinia of the market. If the Trinia of the portfolio is greater than the Trinia of the market, then it indicates superior performance. Then it indicates superior performance. Then it indicates superior performance. Then another line is that if the Trinia of the portfolio is less than the Trinia of the market. If the Trinia of the portfolio is less than the Trinia of the market, then it indicates inferior performance. Then it indicates inferior performance. Then it indicates inferior performance. Then finally, the last dash, you also say that if the Trinia of the portfolio is equal to the Trinia of the market. If the Trinia of the portfolio is equal to the Trinia of the market, then it indicates efficient performance. Then it indicates efficient performance. Then it indicates efficient performance. Then now a new paragraph, we note that this measure operates effectively. This measure operates effectively. This measure operates effectively under the assumptions of CAPEM. It operates effectively under the assumptions of CAPEM. It operates effectively under the assumptions of CAPEM, since it measures the systematic risk. Since it measures the systematic risk, since it measures the systematic risk, it measures the systematic risk using the beta factor. It measures the systematic risk using the beta factor. Using the beta factor. So we can now go to some of the questions in your past papers to see how we can use that measure. So the first question, we can go to the one for November 2020. November 2020 question 2 part A. We can check November 2020 question number 2 part A. Remember it was page 19. Page 19. We can check the question for November 2020. Question number 2 part A. November 2020. Question number 2 part A. So we had already done the question. So we are simply doing the Roman letter 2, the Trinia alpha. So we had done the Roman letter 3. So the question reads that should be November 2020, question number 2 part A. So that question was written, the following information relate to 2 mutual funds operating in your country. So there was Omega and Beta. So you check on page 19. Then they had given you realized return, which was the same as expected returns. Then you are given the beta factor the standard deviation, then additional information, return of the market index was 12, then the risk-free rate was 8. So required for each of the above funds, compute the following performance index score. So we are on the Roman letter 2, the Trinia's alpha. So you want to simply compute the Trinia. So to get the Trinia of the portfolio, when you want to compute the Trinia of the portfolio, so for us to come up with the Trinia of the portfolio, so Trinia of the portfolio, it is supposed to be given by expected return of the portfolio minus the risk-free rate. We divide by the beta factor of the portfolio. So we compute for each fund. We start with the one for omega. We start off with the one for omega. So if you check the one for omega, expected return, that's the same as the realized return for omega. You are given a figure of 13. Then risk-free rate in the note number 2, it was 8. Then remember to divide by the beta factor for omega. That beta factor is given as 1.0. So that one is 1.0. So that now we give you for omega. The next one is the one for beta. The next one is the one for beta. When it comes to beta, you are also given realized return or expected return. They gave you 18. Risk-free rate is 8. Then the beta coefficient for that one you are given 0.0. So that now will be able to give us. So this time they did not for the market. They did not ask for the market. They only wanted to get the Trinia alpha. So each one of them was to give you 1 mark as per that scheme. So each one of them was to give you 1 mark. So that is now the Trinia alpha. So we go to another question. We check a similar other question. So this one was, it was the one for May 2017. Check May 2017. May 2017. It was question number 2, part B. May 2017. There was a question number 2, part B. May 2017. There was a question number 2, part B. May 20. It is on page 47. When you check over page 47, we shall get the information about that. So on that page 47, the question number 2, part B, where you are told that the following information relates to the performance of the 6 portfolios. The following information relates to the performance of the 6 portfolios over a 7-year period. 6 portfolios over a 7-year period. So you are given portfolio PQRSTU, also average annual return. You are also given the standard deviation of the average annual return, then correlation with the market return. So required, rank the performance of the above portfolios. Now we are on the Roman letter 2. So they have been put in there as Roman letter 3, but it should be Roman letter 2, the Trinia's method. We want now to rank them using the Trinia's method. So the major challenge with that question, there is no beta factor that is given, but we can calculate using the information given. Using the information given, we shall compute the beta factor, then we do that. So in our arrangement on that, because they want you to do the ranking, they want you to do the ranking. So in your arrangement, the issue is the beta factor. The issue there now is the beta factor because it was not provided. So what we shall do in relation to that, we shall have each portfolio, then we shall also be able now to get the formula on how to get the beta coefficient. Then we arrange them to do the ranking. So let us have it in this manner. we can have the column for the portfolio. Then the beta factor of security X. Now for this question, it will be given by correlation coefficient between security X and the market, multiplied by the standard deviation of security X. Then you divide by the standard deviation for them. We have used that formula before. So as per the information in that question, that's how we should be able to calculate it. You get the correlation coefficient between the security and the market, multiply the standard deviation for the security. Then we divide by the standard deviation for the market. Or maybe you can write it this way, the beta for the portfolio. You get the correlation coefficient between the portfolio and the market. Multiply the standard deviation of the portfolio, divided by the standard deviation for the market. We can have it presented like that. The correlation coefficient between the portfolio and the market. Multiply the standard deviation for the portfolio, divided by the standard deviation for the market. Then, to get the Trinia of the portfolio is expected return of the portfolio minus the risk-free rate. Now you divide by the beta factor of the portfolio. Then, now you will factor in the ranking. You will be able to factor in the ranking because they wanted you to do the ranking. So that we come up with the ranking at that level. So that we do the ranking. So we present them in this order. We present them in this particular order. So we start off with the portfolio P. We start off with portfolio P. Under portfolio P, check the correlation with the market return. Are you able to see correlation with the market return? It is 0.81. Then check under still that portfolio P. Are you able to see the standard deviation of the annual return? It is given as which figure? They are given 57. Then we need to identify the standard deviation for the market. So check before required. Are you able to see somewhere market return and risk-free rate? So under the column for the market return, can you correlate and check under the standard deviation? Under the standard deviation, they have given us a standard deviation of which figure? 12. So you divide by 12 like that. So that we come up with what is supposed to be a beta of that portfolio. You can round it off in case it is more than 2 decimal points. Just have it as 2 decimal places. 1.82. So number 1.82. Then are we getting 1.82? Yeah, so now after that, we get now the Trinia of the portfolio. So that Trinia of the portfolio, are you able to see expected return for that portfolio P? Average annual return is the same as expected return. They have given us 18.6. So we take 18.6. We take 18.6. We subtract risk-free rate. Are you able to see the risk-free rate? They have given us 9. They are able to give you 9. Then you divide by 1.82. So that we get now the Trinia of that portfolio. You can also round it off to 2 decimal places in case it has several. Sorry? 5.27. So that is now for portfolio. So the ranking will be done after you have computed for all of them. So now we go to portfolio Q. We go to Q. So when it comes to Q, we shall also be able to do the same. Correlation coefficient is given as 0.65 multiplied by the standard deviation, which is given as what? 18. The standard deviation for the market remains at 12. The standard deviation for the market will remain at 12. Sorry? 0.998. So now you also come at this point. You can see expected return for that portfolio. It is given as what figure? So 14.8 also minus 9. We now divide by what? 0.98. So that is now for Q. That is for Q. We got the next one, which is supposed to be R. We got the next one, which is supposed to be R. Check the next one. So for R, correlation coefficient with the market return, it is 0.98 multiplied by the standard deviation of that portfolio, which is given as 8. And then 12 remains the same for volume. So that should give us around which 0.65. And when it comes to this point, expected return for the portfolio will be which value? So 15.1 minus 9 and also divided by 0.65. So I want you to do the same for S, T, and U. S, T, and U like that. And once you have calculated for all of them, then we can be able to do the ranking. Once you have computed for all of them, then we can be able to do the ranking. So in our ranking, which one is number one? U is number one. Yes. Then number two? Yes. Number two is S. Then now that will give us the next part of the question. You can see part C. So part C, they were asking you that compare the ranking using the two methods. Compare the rankings using the two methods above, in part B above. and explain 2 reasons behind their difference. So I want you to go to the sharp index and check what we did for the ranking. Then now compare with this one. So is number 1 still the same? Number 1 is still the same. How about number 2? Number 2, it is not the same. Then number 3? Number 3, no. So from there, you can see that there is differences in ranking when you use the 2 methods. So that's now our part C of the question. They were saying that compare the rankings using the 2 methods in part B above and explain the reasons behind their difference. So let us explain the reason behind the differences in the ranking. Let us now explain the reasons behind the differences in their ranking. So according to their ranking, number 1 is the same, but most of the others, they are not the same. So why are they different? Why are they different? So the difference, we already know some of it. One of the key reasons is that you remember under the sharps method, we were using the standard deviation, but under this one, we use the beta coefficient. Then the other reason, before we write, when we are using the sharps, we say that it operates effectively under the assumptions of portfolio theory. But this one is operating under assumptions of CAPM. So that's now the key reason why the ranking is different. So let us start with the reason number 1. We start with the reason number 1, why they are giving us different results. So number 1 is that under the sharps method, we use the standard deviation. We use the standard deviation to measure the performance. We use the standard deviation to measure the performance. We use the standard deviation to measure the performance. While the Trinia's method, we use the beta factor. We use the beta factor to measure the performance. We use the beta factor to measure the performance. We use the beta factor to measure the performance. So that's the first reason why they are different. Then reason number 2 is that the sharps method operates under the assumptions of the portfolio theory. It operates under the assumptions of the portfolio theory. It operates under the assumptions of the portfolio theory. While the Trinia method, operates under the assumptions of CAPM. It operates under the assumptions of CAPM. It operates under the assumptions of CAPM. It operates under the assumptions of CAPM. So that's now about the part C of the question. So now we need to go to the measure number 3. So remember the measure number 3? Yeah, so we got the Jensen's performance measure. Number 3 was the Jensen's performance measure. We got number 4, the Jensen's performance measure. Prayers now, yeah, so I will give you a short break for those who are going for the prayers. Then we proceed after that. So let us have a short break. So let us now go through that second measure. So the third one, sorry. So the third one was supposed to be, so let us now go to the Jensen's performance measure. We got the performance measurement number 3. We got the performance measure number 3. So that performance measurement number 3, the Jensen's performance measure. So even for that, we simplify that. This measure assumes that CAPM is accurate. It assumes that CAPM is accurate in evaluating the returns of the security. CAPM is accurate in evaluating the returns of the security. CAPM is accurate in evaluating the returns of the security. The returns of the security. It therefore involves computing. It therefore involves computing. It therefore involves computing the alpha value, as follows. Computing the alpha value as follows. It involves computing the alpha value as follows. So to get the alpha value, it will be given by expected return of the portfolio minus the return of the portfolio. So alpha value will be given by expected return of the portfolio minus the return of the portfolio. So return of the portfolio is given by security market line. The return of where the return of the portfolio is given by the security market line as follows. So this period, then we add expected return for the market minus the risk-free rate. Then now you multiply the beta factor of the portfolio. So to get the alpha value, it is expected return for the portfolio minus return for the portfolio. So this expected return is the average return. This one is the average return, but this one you calculate it using the security market line. And now we should get the difference to make the decision for that. Then we continue by noting that the final decision will be made as follows. 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 So the first dash is that if the alpha value is greater than 0, if the alpha value is greater than 0, then it indicates superior performance. If the alpha value is greater than 0, then it indicates superior performance. Then it indicates superior performance. Then the second dash is that if alpha value is less than 0, if the alpha value is less than 0, then it indicates inferior performance. Then it indicates inferior performance. It indicates inferior performance. Then the second dash is that if the alpha value is equal to 0, if the alpha value is equal to 0, then it indicates efficient performance. Then it indicates efficient performance. Then it indicates efficient performance. So that is now for the Jensen. So I want us to go back to that question for May 2017. Question number 2, part B. Question 2, part B. I want us to add there Roman letter 3. I want us to add there Roman letter 3 as Jensen's method. We add there Roman letter 3 as Jensen's method. It was not there, but we can do the same question using the Jensen's method. So that Roman letter, so there was Roman letter 1, the Sharp method. Roman letter 2 was the Trinia's method. So we can add there the Jensen's method, so that we also do the ranking of that question now using the Jensen's method. So let us now check that same question. The question is for May 2017, question number 2, part B. We had already done Roman letter 1 and 2. So I want us also to include there Roman letter 3, even though the question did not ask. But assuming they also wanted you to determine or to rank them using the Jensen's performance. So what you will do for that, what you will do in case of that, what you will do in that area, we shall be having a column for the portfolio. Then return of the portfolio, which will be the risk-free rate plus in brackets expected return for the market minus the beta factor of the portfolio. Then after that, you now get the alpha value, which is expected return of the portfolio minus the return of the portfolio. Then you will also do the ranking. You shall also be able to do the ranking. You shall also be able to do the ranking that order. So we can have the portfolio, then return of the portfolio, then also alpha value, and also the ranking. The alpha value, and then also the ranking, and also the ranking, and also the ranking. So we start off with the portfolio P. We start off with portfolio P. So when it comes to portfolio P, risk-free rate, we know it was which figure? It is 9. Then we add in brackets. Expected return for the market, we know it was which figure? It was 12. Also minus 9. Then confirm in the Roman letter 2. We had calculated the beta factor for that first one. 1.82. To be part of your figure. Yeah, so now you can give me that by 14.46. Like that. Then now after that, you come to the alpha band. We shall now come up with the alpha value. So to get the alpha value, Expected return of the portfolio is the average annual return. Remember 18.6. Then now you subtract 14.46. So get that value. So we shall rank after we have calculated for all of them. We do the ranking after we have calculated for all of them. So that is now for the first one. Then we go to the second one. The second one will be Q. The second one will be Q. When it comes to Q, it is 9 plus also 12 minus 9. What was the beta factor for the Q? 0.98. And we also come up to the value for that. So 11.94. Then now when it comes to this portion, you can see the expected return. It was 14.8. So 14.8 also minus 11.94. You get the value for that. So you will do the same for R. Also S, then G, and also U. That one. So do the same for also R, S, T, and U. Then you will also do the rank. The one with the highest, you rank as number 1. You will also be able to do the rank. So when you do the ranking, number one is still the same. Now it has changed. Now number one has changed. Because the other two methods, number one was remaining the same. But this time, which one is number one? This is now number one. You and your number one. Just confirm. We confirm and see. So after that question, we can now check another similar question. So this one should be November 2017. Let us check also November 2017, question number 2, part C. We now also check November 2017, question 2C. Also check November 2017, question number 2, part C. November 2017, question number 2, part C. It should be page 42. When you check on page 42, you will get that for November 2017, question number 2, part C. Are you able to see the question number 2, part C? So let us go through that question. The one for a Texas investment has initiated an investment fund, called FIDICA. The funds of which will be invested. Only in the stock and bonds. Only in the stock and bonds of infrastructure and construction of companies. Infrastructure and the construction of the companies. So 60% of the fund value is invested in the companies engaged in commercial construction services. And the other 40% in the companies engaged in developing residential properties. So the average beta of the returns from the development of the industrial properties is 1.9, and that of the commercial construction services is 1.4. When you go to the next page, the benchmark market return. So someone is finding out. So we are doing the question for November 2017. November 2017, question 2, part C. November 2017, question 2, part C. So when we proceed, there was the benchmark market return. The benchmark market return is 11.2%, while the treasury bond would carry an interest rate of 4.25. So that is the same as the risk-free rate. Any interest on the treasury bond normally represent the risk-free rate. That will be a risk-free rate. Then the following information are on the net asset values per share is provided. So they have given you the month. You can see from January, they gave you the closing net asset value, also the dividend payout. Then, so they have given it from the month of January to December. Then at the end, they also gave us the opening net asset value for January, which is given as 17.75. 17.75. So required, calculate the Jensen's alpha relating to FIDICA and use it to evaluate the fund's performance. And use it to evaluate the fund's performance. And use it to evaluate the fund's performance. So that question has not given you the expected returns and also the required returns. So we need to compute that. So we shall start with calculating the percentage expected return of the portfolio. We shall start off by calculating the percentage returns. So first, to get the total returns, when you want to compute the total return on the security, we normally get some capital gain plus the dividend. So total returns, the total returns is normally given by the capital gain. The capital gain, then we add the dividends. Then we add the dividends like that. Then remember, capital gain is the same as P1 minus P4 like that. That's now the capital gain. P1 is the value at the end of the year. P4 is the value at the beginning of the year. So the difference will give you the gain. The value of the share at the end of the year minus the value of the share at the beginning of the year. That's now the capital gain, which is the same as the profit. Then at the end of the year, you are also paid dividends. You are also paid dividends. Remember, when you buy a share in a given company, you are paid for items. At the end of the year, the share will have been appreciated. That's now our capital gain. Then also at the end of the year, you are paid dividend. That's now the total return on the share. But we should come up with a percentage return for that. So to compute the percentage expected return, percentage expected return of the portfolio, what do? You simply take now our P1 minus P4, then we add P4. And remember, we are also dividing by P4, and we express it as a percentage. Now to get the percentage expected return of the portfolio, simply get the total returns divided by P4. Then you show it as a percentage. Then capital gain, we have simply said that it is the value of the share at the end of the year minus the value of the share at the beginning of the year. The appreciation in value. Then now you add the dividend you will be paid at the end of the year. Then divide by the price at the beginning of the year, we get now the total return. So our gain is made on the basis of the net asset value. So net asset value at the end, we minus the net asset value at the beginning. Then we come up with that. So we shall compute for each month. We compute for each month. Then we shall add them together. So starting from January, starting the one for January, P1 is the closing net asset value. Are you able to see in January the net closing asset value? I'm going to prepare 18 point what? 18. So that is now our P1 in January. Then I want you to check before required. You can see before required. The opening net asset value for January. Or to prepare 17 point what? Yeah, so that is now our P4, 17.75. That will be our P4. Then we add dividend. So check under the dividend payout under January. Are you able to see anything under January? I'm going to prepare a dash, which means it is a 0. So then now you also divide by 17.75. Then express that figure as a percentage. Express that value as a percentage. So you can round it off into 2 decimal places. Remember to round it off into 2 decimal places. That's where it's 4.7. 4.7. 4.7. So that is now for January. Then we go to February. We go to the one for February. So February, what is the closing net asset value for February? This is 17.80. Then the closing for January is the opening for February. The closing for January is the opening for February. So what was the closing net asset value for January? Yeah, so the closing for January is the opening for February. So this is 18.60. Then I want you to confirm under February. What are we given as the dividends in the February month? Yeah, so you add 0.75. Then also divide by 18.60. Then express that as a percentage. Then we express that as a percentage. So that is for February. That is meant to be February. Then after February, we shall go to March. After February, we go to March. So March, you are also given net asset, the closing net asset value, which is 18.2. Then we subtract. The opening is the one for February, which is 17.8. So, were there dividends? No. Then also divide by 17.8. So express that as a percentage. You express that as a percentage. So you do the same for April. You do the same for May. You do the same for June. You do the same for July, August, September, October, November, and December. So once you have calculated for each month, we shall now be required to add them together. Once you have calculated for each month, remember to add them together. So when you add, you are getting a total of 15 pointers. A total of 15 points. Yeah, to the sum round off to 2 decimal places. So it will give you around 15.5 something. Yeah, so around somewhere there, it is 15.5 something like that. So that is now the one for the expected return of the portfolio. So let us now also check the first paragraph. So those who are online, you are getting which figure? If you can confirm to me. Online, you are getting 15 point what? Anyone who have calculated and added all of them, yeah. Someone also online is confirming 15.51. Someone else got 14.39. You confirm that is not the correct figure. The 14.39 is not the correct figure. It should be around 15.51 to 3 up there. So we also check now in someone else has gotten 15.53. So it is within 15.51 to around 15.53, depending on how you rounded them off. So we now go to the second paragraph. Check the second paragraph where you are given information that, check the second paragraph where they said that 60% of the fund value is invested in the companies engaged in the commercial construction services. the commercial construction services, and the other 40% in the companies engaged in developing residential properties. Then the average beta of returns from the development of the industrial properties is 1.9, and the commercial construction services is 1.4. So that part will assist us to get the return of the portfolio using the security market line. So we need to come up with. So to compute now the return of the portfolio. So return of the portfolio is supposed to be given by the risk-free rate. Then we add expected return of the market minus the risk-free rate. Then we multiply by the beta of the portfolio. So we need now to compute the beta for the portfolio. So to calculate the beta for the portfolio, we use that second paragraph. So in that second paragraph, they have said that 60% of the fund value is invested in the companies engaged in the commercial construction services, and 40% in the company engaged in the developing residential property. So you can see 60 plus 40, they add up to 100. That will give you the proportion. So the beta for the portfolio is the weighted average. It will simply be the weighted average. So we start with the one for the commercial construction, because the one is 60%. So 60% is the same as 0.6. So what is the beta factor of that commercial construction services? You can see the beta for the commercial construction services. It is 1.4. Now, 60% is for the commercial construction services, isn't it? So check the beta factor for the commercial construction services. They have given us 1.4. So multiplied by 1.4 like that. Then we add. The other one is supposed to be 40%. 40% is for the industrial property. So 40% is the same as 0.4. So what is the beta factor that is there for the residential properties? 1.9. So you combine them together in that manner so that we get the beta factor for the portfolio. Sorry. Exactly 1.6. So now once you have that, we compute now the return of the portfolio. So risk-free rate, go to the next page. When you go to the next page, the question had given you the benchmark market return of 11.2, while the treasury bond will carry an interest rate of what percent? So we take the 4.25, then we add in brackets. Market return is 11 point. Is it 11.2? So also subtract 4.25. And now the beta factor is 1.6, like that. The beta factor is 1.6 to give you the return of the portfolio, so that we come up with the return of the portfolio. 15.35. 15.37. Yeah, so now once you get that value, we now compute the alpha value. So alpha value is supposed to be given by expected return of the portfolio minus the return of the portfolio. So alpha value is expected return of the portfolio, we minus the return of the portfolio. Expected return of the portfolio is what you added from January to December. For December, the 15 point what? It was 15.51. Then now this one is 15.37. So that now should give me the alpha value. Now give me the alpha value. So we shall use that now to comment about the performance. We should be able to apply that to tell about the performance, so that we come up with the performance. So that we come up with the performance. So is it more positive or negative? Yes, we are getting a positive figure of 0.14 like that. Yeah. So they were asking you to calculate the Gen 6 alpha and then evaluate the fund's performance. So we can now comment that it indicates superior performance. It indicates superior performance. It indicates superior performance. Since it is alpha value, since it is alpha value is greater than 0. Since it is alpha value is greater than 0. The alpha value is greater than 0. So that's now the comment in relation to that fund. So we need now to go to the last performance measure. Which was the last performance measure? Let us go now to performance measure number 4. It was appraisal ratio. Appraisal ratio or information ratio performance measure. Appraisal ratio or information ratio performance measure. Appraisal ratio or information ratio performance measure. So appraisal ratio or information ratio performance measure. So for that, we can summarize that these measures, the portfolio average returns. It measures the portfolio average returns. It measures the portfolio average returns in the excess of the benchmark portfolio, in the excess of the benchmark portfolio, in the excess of the benchmark portfolio. It therefore involves the cost-benefit ratio analysis. It therefore involves the cost-benefit ratio analysis. The cost-benefit ratio analysis, which is used to evaluate the performance of the portfolio. Which is used to evaluate the performance of the portfolio. Which is used to evaluate the performance of the portfolio. Let me continue by noting that it is computed as follows. 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 So, to compute the appraisal ratio will be equal to the alpha value, then we divide by unsystematic risk. Systematic risk. So to compute the appraisal ratio, you simply get the alpha value, we divide by unsystematic risk. We divide by the unsystematic risk. Then you also add the paragraph by noting that the higher the ratio, the better the performance. 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 So we shall be using the question for November 2015. November 2015, question number 2, part D. November 2015, question 2D. So we shall not finish the question now, it's almost time. So we shall stop there. When we meet now in our next class, we shall conclude on that question of November 2015, question number 2, part D. November 2015, question 2, part D. So let us stop there for now. We can stop there for now. When we meet, we shall now check on that.